despite the last few days when we've seen a tick up in our equity prices here in South Africa, markets have been increasingly volatile and negative for most of this month. How much of this is due to seasonal factors, so the whole sell in May and go away? And what role does the news coming out of China play in this? Because we have seen a downtick in economic activity there.
I think the sell in May go away theme probably is holding this year. But more what's happened in May is that there's been quite a bit of negative news coming out of the US in terms of durable goods orders, employment creation on the jobs front. So that's been a bit of a dampener on the markets. On the Chinese front, although one expects the Chinese economy to slow because the Chinese authorities are trying to slow down growth there's a speculative bubble, as we know, in the Chinese housing market, and that's what they're trying to slow down. So that's, economic growth in China might decline to 8% or even 7%, but that's still very good economic growth. All they're trying to do is to try and move a speculative bubble in housing, but they're not going about in stopping capital spending on the other activities or other areas of the economy, other construction spend, and that's still carrying on investment spending in terms of creating bigger and greater infrastructure, in terms of the high-speed rail spend, and that's still carrying on. So I'm of the view that all they're trying to do is just trying to prick a bit of a bubble in one area of the economy, and China will still be growing for many years to come, and because they've got a big population that's still got to urbanize, they're still on a low income base, so there's a lot of positives still in China. So I wouldn't, at this point in time, maybe in the short term you might have a little bit of a slowdown, but I don't think the market has possibly overreacted to that news.
Well, we still have that inflation looking pretty high in China, and Goldman Sachs expecting inflation to have risen to 5.6% by June. So we could see more monetary tightening coming through from China. Do you think this is going to continue to be reflected in what commodity prices do? Because we have seen those commodity prices pulling back every time we get negative news out of China, such as on Monday when we had that reading on PMI for this month.
They will most likely go ahead until they see definite signs of the housing prices coming down, and I think that's starting to happen now. You must remember, monetary policy you don't get the immediate effect. It's about a year or 12 or 18 months down the line when you start seeing it. So the Chinese authorities are going to be very cautious where they don't overdo it to the extent that the economy slows down a lot more. I'm of the view they're a lot more sensible in that respect, and they'll probably wait and see till before they put through any other measures in place to try and reduce to slow down the economy so that you don't have a bubble developing there. But overall, I'm confident in their ability to know when to stop and to let the economy grow again.
So how does this all affect your view on what commodity prices are going to be doing? Because we have seen those commodity prices quite volatile this month. We've seen sharp pullbacks followed by recoveries. In fact, recovering yesterday quite nicely with that copper price back above $9,000 a ton. We had Brent crude back at $115 a barrel. What's your view on commodity prices, and what's the likely feed through to the JSE and to our resources stocks?
Yeah. I'm of the view that the US economy, you'll probably, and out of Europe, you'll probably get some more bad news coming through. The excesses there have been too much. It's going to take them a long time to get to a normal level of growth. They need to work out all the excesses. They need to work out the sovereign debt problems in Europe. However, I'm of the view that China and India, to a certain extent, is different. And they not only do they have the ability to export to developed countries, but they also have to manufacture and produce for their local economies. And consumer demand, especially in China, is still at very, very low levels compared to what's happening in the US and developed economies. So I'm of the view that the Chinese consumer and the Indian consumer will still be there. They've also got a very high savings rate, so they could potentially decrease the saving rate and increase consumption. I'm of the view that economic growth, because of the Indian and Chinese, the growing Indian and Chinese consumer, both from an urbanization perspective and also them wanting to increase their economic wealth, they would keep on growing the economy. The one thing what we should remember, someone told me many years ago, The problem with the Chinese is that there are more than, I think, 1.3 billion of them. The problem with them is that every Chinese wants to be a billionaire. And in terms of that, there's this whole need to try and grow, to try and increase wealth, to try and consume, to try and look better than the next person. So longer term, I'm still positive on China. And coming back to commodity shares, I believe that it will support commodity shares. We will have these ups and downs in the short term on commodity prices. Longer term, it will keep it buoyant. It might not go much higher than current levels, but it will slowly grow because of the demand coming out of China and India.
And our resources stock shares?
That should be good for South African resource shares. They already, I must say, South African resource shares have already priced in lower commodity prices. If you look at the price earnings multiples, they're around 10, or in certain instances, they're below 10. So the market already doesn't believe higher commodity prices. So I'm from that perspective, I think it's already priced in lower commodity prices. If China and India surprise on the upside, commodity shares, South African resources shares, selected shares will do very well.
So which ones would you be looking at? Some of the big diversified miners are Anglo-Americans and BHP Billitons and the likes.
Yeah. Those are the most likely candidates, the Anglo-American, the BHPs. You have Kumba Iron Ore. I would also look at S-Ore. I look at some of the coal miners like Exxaro. So yeah, there's some good quality mining shares on our exchange. Platinum, Impala has underperformed significantly over the last year or so. There's some more bad news coming that has just come out. However, I think in certain instances, the Zimbabwe issue in Amplats has been overdone. That again is a potential opportunity there. So broadly, Sasol is another opportunity in terms of energy demand. It's okay. The dollar oil price coming down is good for inflation in South Africa, lower inflation. But I think with the rand slightly weakening now, it should be good for Sasol in the long term.
Well, Asief, you said every Chinaman wants to be a billionaire, and I suppose internet billionaire is one of those we could look at, and Tencent doing very well over in China and also very well for our Naspers. Give me your thoughts on LinkedIn. So another internet company floating last week, that share price doing astoundingly well last week. LinkedIn, do you think we're pricing in too much from these new technology shares?
LinkedIn on its IPO has doubled from $30 to in fact more. It's gone up to about $87 or $90 last week at its IPO. It's an interesting opportunity because about 48% of its revenue comes from recruitment. The recruitment agencies, they pay, my guess is about $20,000 a year to use the advanced features. Okay, that's a small market, but they do use that to get potential candidates. The balance comes from advertising on their website. If I had a look at the actual website, and it seems to be catching on with a lot of prospect employees, current employers who currently have jobs, and people looking around for jobs. It's done too much. It's expensively priced at the moment. It's about 28 times sales. It hasn't made a profit, hardly make a profit. It might make a profit in the next couple of years, and it probably will. But I think what the advantage with LinkedIn is it's got a first mover, to a certain extent, a first mover advantage. On the other hand, also, it's got a lot of competition from the other competing agency, web recruiting agencies such as Monster and Career Builder. So the competition is going to be extreme, and it might mean that they won't be able to maintain their pricing power. I think it's overdone at the moment, but it just shows you the value of these internet sites like Tencent, and that obviously filters through to Naspers.